Hey, it's Rav. Welcome to the Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show is designed to help us grow our money. You see, often we take our precious time, we go to work, which is a blessing. We make money in order to provide. We take our time, we go to work, we get paid so that we can eat. But imagine a life, if you would like, where money makes you money, so that you could work a little less and take that time, spend it with family, friends, engage in a purpose greater than yourself, all that kind of good stuff. Super excited about this show. We're going to be talking to my good friend. Wait for it. We'll be right back.
Everybody knew they were going up. There was no question of rates going up, and they needed to go up. But I think it's important to circle back and talk about why interest rates go up. Interest rates go up to cool, to tame, to control inflation. Now, generally, when we're seeing an inflationary market and we're seeing inflation happening a lot, it's because the market is really good. Business is good. The supply chains are healthy. Things are moving and producing, and employment is great. And in this specific circumstance, we're not necessarily seeing a lot of that.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it to you for free? That's right, zero commissions. Head over to our website, everydayinvestor.com, to find out more.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rob. Welcome back to Everyday Investor. I'm talking to my good friend, Kyle Ford. He's going to be teaching us how we can still make great returns even in a down market. Kyle, so great to have you on the show. And by the way, congratulations. I heard you just got married. You and the lady went out to, where? Vegas, I think, right?
Went to Vegas, yeah.
Yeah, no, that's super exciting that you were able to do that. And thanks so much for racing back here and being on TV with me. It's here we are in the month of September, and it's a crazy market out there. Kyle, I just want to, you are the guru when it comes to money in general, borrowing, lending, the economy. So I just want to jump right in. I thought that inflation means things are good. And so therefore we can afford to kind of bring down, raise rates to be able to curb it and so on and so forth. I thought the government were going to do things slow and steady, but it seems like we're getting a bit of a spanking here. Like it's gone up 3 points. From a quarter to 3 1/4. Is that right? Am I correct in saying that? It's gone up 3%. So if somebody has like a $500,000 mortgage, a lot of people have a lot more than that, but a $500,000 mortgage, 3%, $15,000 in a year. $1,250 more a month, I think, if that's the right math. What's going on? Why is the government doing what they're doing? And is the government, is that the right terminology? Government, Bank of Canada?
The Bank of Canada, yes. So it's been, it's certainly, let's start with from where interest rates were at a quarter point. Everybody knew they were going up. There was no question of rates going up, and they needed to go up. But I think it's important to circle back and talk about why interest rates go up. Interest rates go up to cool, to tame, to control inflation. Now, generally, when we're seeing an inflationary market and we're seeing inflation happening a lot, it's because the market is really good. Business is good. The supply chains are healthy. Things are moving and producing, and employment is great. And in this specific circumstance, we're not necessarily seeing a lot of that. We're not seeing, that businesses can be struggling in some cases, and the wages aren't necessarily increasing at the same level. This inflationary period that we are seeing seems, and most people would agree with this, to be driven by the amount of money that's being printed. So over the last 2 years, 40% of the money supply is new money that's been introduced to the market. And that's really driven this inflation. Now, our Bank of Canada, the experts and the people that control this interest rate, when they had the interest rate very low, they were very clear and kept repeating that as they were going to do this slow and controlled. And generally, what we've seen in the last decade is interest rates moving at a quarter point at a time, maybe a half point, but slow, controlled, and people can see it coming. Now, as they started increasing rates, they started with a quarter point, and then a half point, and then a point, and then 0.75, and just major increases that were very, very quick. Now, the challenge this introduced is, when interest rates were low, a variable interest rate was still very attractive. And many people who took a variable interest rate thought they would be in a position that as rates start to move slow and steady, they could at that point lock in as they see fit. And if it moved a little bit, judge where they were at in their life, whether they were at in their home ownership or their investment property ownership, and pick a 2, 3, 5 year fixed rate that would align. But with how quickly this happened, it was constantly such a gap to lock into the fixed rate that most people made the decision to stay variable. And as you alluded to earlier, are seeing a substantial increase in their payment.
So right now, variable versus fixed, which one's higher?
A fixed rate is definitely higher than a variable rate still today, even with another increase, which is now being predicted to come. The fixed rate is still higher. So the question we need to ask is, do you want to lock in at an already higher fixed rate? Many of the, once again, experts had predicted that we would see the rates increase in 2022 and then drop again in 2023. I have no idea what they're going to do at this point. It's becoming very difficult to try to make an educated expert opinion on this. A couple key points that I want to drive into people is, first of all, the big concern that I hear from many people is, well, isn't this what happened back in 2008 and the payments started going up and nobody could afford their mortgage? The key thing here is, here in Canada, we've been stress tested for the last number of years to bear these interest rate hikes. People can afford these payments. It may be allocating more of their money to the mortgage than they would like to and cut into some of the luxuries in their life. But in terms of the ability to make these payments, we've been stress tested and qualified to make sure that we can support these payments. So that's a big one to talk about.
So sorry, Kyle. The other thing is that, as investors, most investors that I know, yourself included, we're on variable rates. And we also don't pay off our mortgages. We use our homes as banks, and so or our investment properties, we refinance and so on and so forth. So when I talk to people, this is with your guidance, I have a variable, but my monthly is not changed. at all. It's like a fixed payment, even though I'm variable. Now, obviously, what has changed is the majority, if not all, is going to interest, unless it's going down and paying down the mortgage. But that's okay. The monthly has not changed. But I'm finding a lot of people in the same situations. It's not a fixed payment; it's going up. And so, was that just why we have to be careful with the product that we're getting in? And can they call their bank and change it? And will the bank change it to make it fixed? What would you say to the person? Because what I heard you just say is, if I go fixed right now, those of us that are on variable, I'm going to pay a lot more. We don't have a crystal ball. We could go fixed, and then in 2023, things kind of come down again. I don't want to break a mortgage. It's going to be, I don't want to break a marriage either, but a mortgage, it's going to be astronomical. So then, therefore, I should probably go to the bank and beg that, hey, can you keep my variable payment the same as opposed to going up? What are your thoughts on that?
Yeah, so, and that terminology is called the static variable. So the payment remains static, but the amount of going to principal and interest adjusts as the Bank of Canada moves the rate. I will say, without naming specific lenders, one of the more investor-friendly banks that had a lot of rental properties didn't have a static variable. So there's a lot of people with investment properties that don't have a static variable. I hope that they've been listening to good, prudent advice, which was they had higher cash flow, so they've been stacking that cash flow to weather this storm. Now, there are many, many banks, and even that bank that I'm mentioning that didn't have the static variable now has an option that you can move into. So in regards to static variable, the main downside to static variable as rates going up is your amortization is going up. Now, as a real estate investor, we don't really care about that. We're not as concerned about paying these off. We want to leverage our equity, so it's great. As a homeowner, it's something you want to be cognizant of. Some homeowners have a goal of, I have a 20-year amortization, I'm retiring in 20 years, I want my mortgage paid off in retirement. And if you're in a static variable situation, your amortization is now extended beyond the 20 years, and you would want to adjust to re-amortize adjust your payment to re-amortize your loan back to 20 years. But as an investor, many of whom I know have static variables, they have no issue with this. And what we are seeing right now is that many lenders are hitting their trigger point, which is in the static variable, which means they're calling and saying, you now need to increase. I can speak to personal experience. I did hit my trigger point on one of my mortgages. My bank actually was okay keeping the payment at the same, and I'm paying very, very little principal on a monthly basis. But for me, it was an investment property. The interest is deductible. Made a ton of sense for me to keep it.
So the product is for people for those that you're watching, the product that we want in a variable, because we want to have the option, is called a static payment. Correct?
Static payment variable. Yes.
Static payment variable. If obviously if there's not enough interest and they call it in, do they just adjust for the interest, or do they how much more do they want just to make sure they cover the interest?
Yeah. So, and Rob, this is where in my experience here, I found the banks to be somewhat negotiable here. It doesn't, so the contract reads that you need to increase to bring your amortization back to the original 30 years. Depending on the equity position in the property, depending on your relationship with your lender, I've had several clients that have been able to negotiate terms that were outside the original contract. So in these scenarios, my advice is talk to your lender, talk to your broker, certainly, and really make sure you're reviewing your goals here. Is paying off the mortgage important to you? If you're an investor and it's a rental property, it's not as important. If there's a home ownership goal and a timeline, you need to be cognizant and adjust accordingly. But by all means, talk to your lender. And we are at the point where if you've been in a static variable, you are likely hitting your trigger point, which the lender may force you to increase the payment. But that's where I'll go back to your stress test qualification. Even if you're forced to increase your payment, the payment is still manageable, and it is a payment that you were initially qualified for.
So we're just going to take a break here, and when we come back, we'll get into some numbers of how we can still make money in this, downturn, if you will. But Kyle, you said it very quickly, and it's the most important thing in life, in my opinion, and that's relationships. Obviously, with our nucleus, our family, our friends, our neighbors, literally our neighbors, the guy on the right, the left, across the street, but also what Kyle is teaching us is even in business. And so, it would have been nice if we haven't already bringing a bottle of wine at Christmas to our banker, to our finance person, to be able to say in times like this, hey, give me a break. Can we negotiate something? Anyways, Kyle, you're not just a pretty face. Thank you for your mindset here. We'll take a quick break. We'll come back, and then we'll look at how we can have money make us money. We're talking to my good friend, Kyle Ford. Don't go anywhere. We'll be right back.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it to you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. A few years back, I learned about trading stock options by taking the Theta Trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I am not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more.
Hey guys, Lee here from Wise Construction, bringing you your winter tips to get your homes ready for the change of seasons. So it's a good time now to look at your furnaces, look at your dryer vents, look at everything to kind of seal up your house, change your filters, get your furnaces cleaned out, get your dryer vents cleaned out, kind of get your home switched over for winter. It'll be much more energy efficient. Your home's going to run better, feel better, breathe better, and be cleaner. Any questions, please feel free to reach out to me.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Hey, it's Rav. Welcome back to Everyday Investor. I'm talking to my good friend, Kyle Ford. He's teaching us how we can make money in the downturn. Kyle, things are a little bit challenging, but people are still making money lending money. So here's my thought process. Please nurture me. I know you always do. Don't be afraid to kind of narrow in and give me a slap if I'm not thinking right. Here's my thinking right now. Obviously, if you have registered money, meaning RSP, RESP, ALIRA, TFSA, all that stuff, we should be lending out that money and making our 8 to 12% on that money because it's going to stay registered and we're just going to grow it. That part is simple for me to wrap my mind around, correct?
Yeah,
okay.
Absolutely.
But in the past, a lot of us, we would borrow money because it's so cheap. The money was at 2%, 3%. and then I could lend it out at 12% or so for 1 year, and I would make a 9-10% spread. But now to borrow that money, it might be 5-6%. And if I lend it out at 10-11%, I'm making a spread of 4-5-6%. What are your thoughts on that? And please be candid.
Yeah, so in fullest transparency, when you're borrowing at 3 and lending at 11, it was in my humble opinion, a no-brainer. Now we're at the 5.5 at 11. Our spread's gotten tighter. I think it's important to recognize two things. What's your long-term strategy? Long-term, are you going to be a lender? And are you going to be a borrow to invest lender using your home equity line of credit? I think you just need to be cognizant that sometimes the spread is better than others. And as long as the deal or the file that you're lending on fits your risk tolerance, the spread is the spread. I think most people would agree that the cost of living in across all facets have gone up. Are you able to support your lifestyle or without that income, that 5 to 6% spread? So I am recognizing that to a lot of people that borrowing to invest right now isn't the same no-brainer that it was maybe a year ago. However, is that additional income still helpful as things are more expensive? Is that 5 to 6% spread still helping put gas in the car, groceries, vacations, those type of things? Now, in saying that, there are we haven't seen a massive increase in first mortgages, which are safe, secure first mortgages. Now, we are seeing a spread increase in second mortgages because there's a little bit more risk in that, and the market has changed, where those are returning in the 12 to 13% range. So more of a similar spread to what we were seeing initially. Now, it's got to be the right risk tolerance. You got to be comfortable and understand what you're doing to do a second mortgage. But if you do understand that and it fits your risk profile, that can help maintain that spread that you may be looking for. So
what you're saying is if you're borrowing money and you're paying 5-6%, I can lend my money out and still make 13-14%, but I just got to know, and that's what I love about your outfit, is I'm going to know exactly who I'm lending it to. I'm going to be able to see their collateral. I'm going to be able to put a lien on a property. They're paying for lawyer. And so if I borrow at 6% and I'm making 14%, I'm still making my 8%, is what you're saying. I just got to be able to sleep at night, but I do my due diligence. Knowledge mitigates risk. I'm going to be able to see it all. What do you say to the person, and that's really great, Kyle, thank you, that's helpful. What do you say to the person that says, well, if I'm going to lend you this money, I want the same spread that I had last year, and so why can't the borrower pay me more? What are your thoughts when people come to you? Because I know a lot of people come to you with that kind of notion. What's your thoughts on that?
Yeah, so there's a couple things here, and I'm going to be quite candid. And one of the first questions I asked to the person who's been consistently getting the 11% first mortgage return from me for the last couple of years is, how's your other investments doing the last year? How's your stock portfolio? How's your mutual funds? How are these other things doing? And the answer to them is usually not good. And we've been able throughout this entire last 2 years of turmoil and ups and downs, been able to consistently meet that benchmark return. So that's usually a bit of an eye opener to the person. And understanding that whether interest rates are going up and down, the private money market isn't as affected quite as much. The other thing that I think is really important for people to understand is, could we start, gouging our borrowers and trying to say, yep, you got to pay us more, you got to pay us more? Well, the concern I would have there is the market values of these properties for the borrowers aren't appreciating the same way they used to. They don't have the same margins that they used to have in an upswinging market. So if we're going to try to beat them up and try to squeeze every extra point out of them, are we putting our projects at risk? Or even if we don't put our projects at risk, when they pay us back, are they going to continually borrow from us and maintain that yield? So in the humblest way I say this to some of my favorite people that work with me is, let's not get greedy. We've been getting a consistent, stable return on first mortgages when everything else has been a roller coaster ride. Do you want me to try to beat this guy up for an extra point or two on the mortgage? Or do you want to make sure when he pays this back that he's going to borrow it again and keep your money out to work? And most of my lenders, after hearing that, are totally on board with it.
Yeah, and they're, Kyle, you're offering 1-year terms, sometimes 2-year terms, but I can pick. If it's a 1-year term and my spread is 6%, but it used to be 11, 12%, well, next year it's going to go back to 9, 10, 11%. As long as the return on my investment is healthy, I'm making money, I like where it's going. My accountant always tells me, Rav, a cow gets fed and a pig gets slaughtered. He's saying it's okay to be a cow once in a while, but don't be a pig. Don't be greedy. And so I love your advice there. I mean, as long as our money is making us money, there's going to be times, whether it's stock market, stock options, land development, lending money to make money. Some returns are going to be higher than others. As long as we're having a lot more wins in life than losses, then we've won, right? So no, I really appreciate that. So we can still. So for those of you that don't know, you can jump on Kyle Ford's email list, and you'll be able to see all these opportunities that we can still invest in. And also in October, go to everydayinvestor.com. Make sure you click on upcoming webinars. We only have 24 minutes of real time with my guest today, Kyle. And so we're going to be doing webinars once a month, where in October it's actually Kyle that's going to be joining us, and it's live, and you can ask questions to myself, Sarah Larby, who's a producer of the show, as well as Kyle, and make sure you do that. Okay, so Kyle, so right now, what are you seeing? Are people still borrowing and investors still lending? Has it slowed down? And then there's something that you've got, brewing. Are we allowed to talk a little bit about that? Am I allowed to say a few words or not yet because of legalities?
Yeah, so I can't speak to anything specific, but right now what we do is individual direct lending, which does require a little bit higher minimums from people to get involved in. And it's very deal specific, where you pick a deal and there is a little bit more management involved as the lender. We are in the process of launching our fund. The fund is going to give more diversity to lenders, lower minimums for people to get in, and truly a more passive investment where you can put it into the fund.
Absolutely. No, I mean, it's great, because if I want a piece of everything that Kyle's doing, then I can get in at even lower and still make my healthy returns. When do we think that's going to happen?
For 2023, for sure. Okay. Hopefully a little bit sooner, but for Jan 2023, it will definitely be ready to go. I'm optimistic that it will be sooner than that.
Fantastic. Kyle, love having you on the show. Time is up. It's always a pleasure when I'm being nurtured by you. Thank you for being on the show with me today.
Always a pleasure, Ralph. Thanks again.
Yes, and thank you guys for watching. Without you, we would not have a show. Remember, go and watch our or register for our webinars, everydayinvestor.com. If you want to watch this show again, go to everydayinvestor.com and click on episodes. You'll be able to find this on demand on our YouTube channel. Until then, we'll see you next week, same place, same time. Honey, love you. I'll be home soon. Bye, everyone.